Peter, that is representing the Swedish International Development Cooperation Agency. They are one of the leading development agencies dedicated to guarantees. As well, we have Christian representing the Swiss Trade Secretariat for Economic Affairs, SECO, as well working in guarantees and historically as well implementing guarantees in different countries. And then we have Mark Gibson from UNITAR, from the Global Platform for Action, where we are trying to implement guarantees for a challenge that we have in humanitarian settings. So the objective of this session is basically to talk about the relevance of risk mitigation mechanisms to mobilize investment and finance to address the climate change. So I'm going to give just less than 5 minutes remarks on what is the challenge about, and then the idea as well is to facilitate or to provide 5 minutes to each of you so you can present what you are doing, and then we are going to jump to a session of questions, and the idea is to have an interaction with the audience on the topic. So the session objectives is basically first talk about the importance of risk mitigation mechanisms. We have been talking about the importance of mobilized finance to address climate change. So here is the relevance of using the guarantees or risk mitigation to mobilize the money that is required. We are going to be exploring and talking about successful cases about guarantees implementation, and as well talking about the main risk that when we are talking about climate investments and what we are addressing with these risk mitigation mechanisms. As well, the idea is to talk about best practices, lessons learned, and pitfalls. And as well, addressing barriers and understanding the environment, as well the role that each of the stakeholders have, the development agencies, the financial institutions, philanthropy in this role. So this is the agenda, the remarks, and then the 5 minutes presentation for each of you, and then to have an open discussion with some questions. The idea is to discuss it here with the panelists and with you. Just to start kind of understanding who is in the audience, I'm going to ask you to respond to this small poll to see from where you're coming. If you scan with your phone, there's going to be a link, and so we, as panelists, will know who are we talking with in this session. So we have some development organizations, some NGOs in the audience. And we are going to have, during the discussion as well, a couple of polls where we want to know about your understanding or perception about risk mitigation mechanisms. So, well, we have a lot of NGOs, others. We have some impact investors in the room, development bank, private financial institution, family office. Good. So I think this is going to be incorporated as people start joining the session. So, okay, so what's the problem? As you know, and we have been discussing in these 2 days about the challenge of climate finance. We are talking about to mobilize, the need to mobilize $8 to $10 trillion per year to address climate change from now to 2030, which seems a huge amount of money to mobilize. And from that, the need for developing countries is around $2.4 trillion per year. And I don't know if you recall, but the discussions at the last COP was about developing countries requesting 1.3 trillion, and they are expecting actually the 1 trillion that is additional mobilized from private sector and from local funding. As well, there's an expectation that international funding, around 40% of that is coming from this side of the world. And where we are at the moment is, well, the investments amount at the moment is 1 trillion that has been invested. So we are very far away still from that. And in developing countries, it's around 190 billion. So it's still close to more than 10 times what is required in terms of money. So we need a lot of innovation here because there's not enough money in the public sector to address this need, and as well, not enough money in developed countries to come. So we need as well the local investors in order to address this huge challenge. And this is where risk mitigation mechanisms come into the picture, is because they have the capacity to bring and to pull additional money from the different sectors. And this is the topic of today. So I'm going to give 5 minutes to each of you so you can talk about the things that you are doing in terms of risk mitigation mechanisms, so the audience can know more about your work, and as well the project that Mark is working in terms of the guarantee. And then from there we can start with the questions and discussions. So Peter, you're first.
Thank you, and good afternoon, everyone. When I get questions and been asked to present what Sweden is doing through SIDA in the terms of de-risking for investors, I always need to step back a little bit and say that that's not really the real core of SIDA and the work we're doing. We really start somewhere else. We start with the impact and we end with the impact. So in this regard, we're talking about climate, but for us it's much broader than that, right? It's really enhancing the lives of populations in the least developed countries. And the way we're doing it is that, yes, Sweden is a large contributor to ordinary ODA, but we have also in the last 2 decades, almost 20 years, provided guarantees for development. And it has really taken off in the last 5 to 10 years. And the way we've been able to do it is to structure and be part of structures with the right partners, right? And today we have a portfolio of 2 billion USD guarantees. We have abilities to do 3 billion USD at the moment, meaning that we have 1 billion left, so to say. And we're really putting it towards climate and other priorities of the agency, and basically Sweden. I'm going to focus a little bit on what we do with fund managers and getting basically fund strategies to the market, where we have the last 5 years we've seen a push to be part of fund structures and ensuring that the capital stack or the investors feel comfortable with the risk that they're asked to take. And the simplest way to describe it is that if you have ever been part, or if you're looking to fundraise for a fund and you're saying that, well, the first thing we need is a first loss, who's going to come with the cash? Well, you can call us instead, and we come with a piece of paper saying that this will provide you with a AAA rated guarantee. It's likely not going to provide you with the liquidity in the fund, but the risk share is as good, or if not better, in a sense. The way we've done it, we've worked with partners like Sunfunder. Now they're called Mirova Sunfunder. We have supported 2 of their energy funds in an African context, where we do not only start by saying, okay, what does the investors need in terms of risk reward? We're basically more starting with, what are you able to do without any risk sharing, and how can you get to the markets or the sectors that is a priority for development, right? The simplest way would be to take a Swedish example, where an investor say, I'm happy to invest in Sweden, and I say, well, what if I give you sufficient risk share, either on the on the capital stack level or on the portfolio level, and you can go to the least developed countries. But you will still look for the guarantee to get the risk reward. That's the type of work we're trying to do and where we've been successful. I think the most important thing, again, is to not work with only the right guarantee provider, which could be us, but also for us to work with the right partners, right, that have similar goals, but currently are stuck with mandates that do not allow them to invest, for example, in Somalia or Liberia. But if they would get, again, the risk share, they could, right? Obviously, we do other things as well, and I'm just going to mention it briefly. We work very closely with some of the larger MDBs where we take risk from their balance sheets and they do additional lending. For example, we finalized on a 250 million USD guarantee to Inter-American Bank this year, where we take risk on their sovereign portfolio and they do lending in the Amazonia countries or region, the Amazonia region. That's just one way for us to say that the pocket of money is 100, but if we take off some risk from you, you get a small pocket of money that is dedicated to the right type of investments in the Amazonian context. I'll pause there.
Thank you, Peter. I have a question. Do you have figures on how much the 2 billion allocated guarantees have been able to mobilize in terms of finance?
Yeah.
Investment?
Yeah. The easy answer there is around 4, but that's on a portfolio level. When we work in different structures, obviously it can be quite significantly higher, but it can also be less, right? Some smaller guarantees, we might guarantee 80% or 90% of the risk, meaning that we don't mobilize that much, right?
That's interesting. That just as a comment, the OECD figures from 2022 say that 91.6 billion in international public finance mobilize only 21 billion in private flows.
But I want to just stress the Swedish guarantee model. When I say that we have a 2 billion guarantee portfolio and we mobilize 4, the only public money that we've used is the ODA that we use to subsidize the guarantee fee. And that is way less. We have a ratio using ODA to the mobilization of 70, 1 to 70, right?
Yeah. So that's why the relevance of this leverage power of the guarantee. Christian, SECO.
Yeah, good afternoon, everyone. Yeah, it's always difficult to talk after the Swedish colleagues, especially when it comes to guarantees. But I mean, from SECO side, from the Swiss Development Corporation, I think we also do much more than guarantees. So one of the key areas that we work in is technical assistance to provide systemic reforms in our partner countries, especially on investment, climate reforms, enabling environment more broadly, but also especially in the access to finance for SME area, so especially working with on secure transaction reforms, building up and strengthening credit bureaus, etc. So really to try to, on a systemic level, reduce the cost of capital for SMEs. But then we also see, especially in the climate area, also an urgency to accelerate, and we know that the regulatory changes take sometimes quite a lot of time. And so it's, especially in this area where there's a lot of urgency, it can make sense to use public funding to de-risk, and we've been doing this for quite some time. So for instance, in Peru, Vietnam, and Colombia, some priority countries of the Swiss Development Corporation, we've started doing this in the 2000s, so and has been recently redesigned with the support of BASE. And there we provided partial credit guarantees to local banks that do lend to SMEs for green projects, so especially to invest in greener technology. That was all verified as well externally, so that it was really had an additionality in comparison to conventional technologies that are applied. And I think, yeah, it was also really to demonstrate that while the capital expenditure at the beginning is higher for these new technologies, the operating costs are lower later on. They have lower energy bills, etc. And so this pays off for the SMEs, but also it pays off for the banks that provides the loans. And I think it was quite interesting to see. So we had over 50 companies where we provided these partial credit guarantees. And over 20 years, we had 2 to 3 defaults. So it was really, really small. Then another area more in the infrastructure space, we support for many years the joint action with the Swedish colleagues, the private infrastructure development group, and therein we have a guarantee arm, Garanco, that we support. So it tackles credit risk, is a credit enhancement as well. It's a pooled donor funding, so that we pay equity, so to speak, into Garanco, that then provides guarantees to local banks or infrastructure projects in developing countries. And they can use our equity at least 3 times to issue guarantees. And if you look at the track record as well, so we see that there is about a 9% default, and this is about 50% in least developed countries, this exposure. So that's really impressive, I think, and speaks very much to the efficiency of using guarantees. And then another example is the SDG Impact Finance initiative that we have initiated jointly with our colleagues from SDC, UBS Optimus Foundation, and Luxembourg and others to join there. It's more direct equity, junior equity that we provide into impact funds, so you can apply regularly through call for proposals, and it provides the liquidity as well in the fund, but it's of course not as efficient, also to be very honest, like the guarantees that the Swedish colleagues can apply here. So I think that's a bit an overview, and maybe just to say, I think it's also really important to use guarantees to unlock domestic capital in our partner countries. So for instance, with the Private Infrastructure Development Group, we have supported in Nigeria a local guarantee company that allows also local pension funds, for instance, to invest in infrastructure projects in their own country. A similar attempt, a similar local guarantee company was launched in Kenya just 2-3 months ago, and we're looking to replicate that model more broadly. And this also takes into account currency risks, right, which are a huge part of the de-risking that we need to do. And maybe I stop there just with the reference to TCX, which we're also invested in, which provides currency hedging solutions for lenders, so because the currency risk really make up a large part of the risks in these contexts.
Yeah, Christian, complementing here your efforts, and thanks to this openness to do innovation, in this case of Peru, for example, where you said clearly the objective as well is to mobilize local funding, financing, in a country where SMEs have a lot of difficulty to access credit from the market. In this case, with a little bit of money, which it was $5 million that was put, we was able to increase it to a pot of 35 million for a guarantee using the funding of SECO as a first law. So you start looking here the leverage potential of this funding for specifically for a product, a financial product like a guarantee, which as well the guarantee as a 35, they have expectations to mobilize 10 times to 12 times the amount of money in credit lending to SMEs. So you can see the leverage potential there.
also with the revolving use of it, yeah, exactly. And I mean, that was massive. If you look back these 20 years, I mean, the capital that is still there from that guarantee is still the majority, actually.
Correct. Mark, not coming from the guarantee side, from another angle, I think this is a very good example on how we are trying to address a very critical problem, a very a challenge that has some structuring practices problems to bring the private sector, and how using the guarantee could leverage and unlock financing for this. So.
Yeah, thank you, Daniel, and good afternoon, everyone. It is a very specific challenge, so do indulge me as I give you a little bit of context and introduction. Yeah, my name is Mark Gibson. I'm the team lead for the Global Platform for Action on Sustainable Energy in Displacement Settings, otherwise known as the GPA. We are based at UNITAR, the United Nations Institute for Training and Research. The GPA is a global convening body that promotes affordable, reliable, sustainable, and modern energy services for displaced people, host communities, and the associated humanitarian response. We are steered by 7 UN organizations and 9 international NGOs. One of our core activities is focusing on decarbonizing the humanitarian response. Electricity is vital for humanitarian operations, and we as humanitarians rely heavily on diesel-based infrastructure. For instance, we at the GPA did a little bit of modeling, and based on some responses we got from 6 UN agencies and the ICRC, we estimate there's 11,400 diesel generators in the humanitarian space, just for those entities alone, of which they spend over $100 million a year on diesel, emitting nearly 200,000 tons of carbon dioxide. We have estimated that there is an investment need of nearly $236 million for them to transition to cleaner solutions. In other words, solar or solar hybrid. Given the present funding crisis experienced in the humanitarian sector, this sort of capital is not available, especially for non-core activities, even where we can present a relatively short payback period. Because most of our partners are working on an annual budgeting cycle. And to develop an energy project within the UN or within a humanitarian partner is going to take you at least 2 years, if not 3 and more. As such, the GPA and its broader partnerships are advocating towards the movement towards, power purchase agreements and leasing agreements with energy service companies. So these are private sector entities that are financing, installing, operating and maintaining the energy system and charging the humanitarian partners back on a monthly basis the same cost that they would be paying for diesel or less. It sounds like a fantastic opportunity, especially since many of our partners can sign a 10 or 15-year leasing agreement. However, there are 2 big buts. The first one is when it comes to multi-year contracts. These can only be signed where the energy solution is attached to an office, a warehouse, or a guest house, somewhere where the humanitarians are staying in safety. And in addition to that, any contract must contain a termination clause. This termination clause can actually cancel a contract within 30 days. So as a private sector entity, you have a 15-year contract. When you actually go out to get private finance, it is worthless because your financiers are looking at a 30-day contract. So what we found is very little movement in this space for this very specific reason. So we have been working on a de-risking mechanism that can be triggered when such an event occurs. The present thinking around this would allow a sort of 12-month liquidity facility where once the contract has been terminated, the parties can actually explore alternatives. For instance, is a new tenant arriving to the office, and then can they take over the lease agreement, the PPA? Can the system actually be moved? Is the UN moving? Is it just down the road? Can the system be redeployed somewhere? And then if a solution cannot be found within that 12 months, then the guarantee would be kick in and cover the I always struggle with this word, apologies, unamortized financial commitments. So you can tell I'm not a financier. This would allow energy service companies to enter this space and support the humanitarian partners with the transition to clean fuels. There is an additional opportunity. If we're looking at decarbonising the humanitarian infrastructure, can we then use blended finance to then extend that system and provide energy access into the local community, into the displaced community, especially for productive use, and actually generate opportunities within these communities? Unfortunately, we bring additional risks when we look at these opportunities, especially when we look at the perceived temporary nature of displacement settings, and also the ability to pay. Just very quickly on those 2 points, most refugee settlements have an average lifespan of 18 years. So there is a permanence, especially when we're seeing payback periods of between 2 or 3 years on a solar or solar hybrid system. In addition, many of the displaced communities where they are procuring energy are paying between 2 and 3 times as much as the local communities due to access restrictions. This is a completely different risk associated to the purely termination clause. It has additional concerns. Therefore, we're likely to be dealing with different energy providers and different actors. And this is where we've been working with BASE to actually look at the role of a philanthropic guarantee, which would again cover the unamortized costs, where each guarantor, is committing a certain amount of money over a defined period. For instance, $1 million over 10 years to cover any costs associated to non-payment for that system. We also believe that many of these contributors to the philanthropic guarantee could actually get some tax benefits for doing so. Apologies, this is a very quick and overview of what is quite a complex problem, and I'm sure there'll be more questions around this later, but thank you, Daniel, for giving me the opportunity to raise it in a different community than we're used to talking to, so thank you.
Thank you, Mark. And I think it's a very, very interesting point as well that we can think about in terms of what does that project imply and how we can reflect that to the challenge that we have ahead about the financial mobilization into this. Because it's a clear example of a problem where the risky mechanism can help to mobilize investment. Just to add to what you said, the idea here is to build this guarantee that is focused specifically on the risk of the early closure of a refugee camp. Why the early closure? Because as Mark was explaining, all these contracts from the private sector that they are offering to provide solar photovoltaics. In a normal company, you can sign a contract of 15 years. You cannot do that in a humanitarian setting or with an entity. You have to do this in an annual basis. And the second thing is, what if they close early because the camp has to close, and then the time remaining, who's going to pay me for the investment that I was not able to recover? And this is the guarantee that we are trying to do here. There's a lot of innovation here in terms behind, because it's not the typical guarantee that you have to monetize. We are thinking about a philanthropic guarantee where basically you collect commitments from philanthropists that they will pay just in the case that these risks happen. So you don't have to have the money there. Very much similar to what CEDA is doing. They don't have the money there to extend the guarantees. It's a commitment what you are establishing. And here is the trustability, the credibility of these philanthropies that are backing this aspect. Now, I'm going to just finalize this session with BASE. BASE is a foundation. We were established in 2001 as an initiative between City of Basel, the Swiss authorities, and the UNEP to create an independent center specialized in financial mechanisms and business model. We have been working with entities like SECO, like GPA, in designing these instruments. We are kind of a sandbox where we design this and we test this in the market. And the idea here is how do you make something sustainable and scalable and transformative that we bring the trillions that are needed and in a systematic way. In this specific case of the guarantee, one of the aspects that we always evaluate, that we analyze, is how other sectors are doing in terms of this. And Switzerland is actually an example of a country that managed very well the insurance sector, and they are super good in distributing risk among a chain of different stakeholders. So you have in a country the insurance company that provides the life insurance or the car insurance, but they are not taking or bearing the risk by themselves. They have a second level, which are the reinsurance companies. We have a big company in Switzerland that is called Swiss Re. In Germany, there's another one that is called Munich Re, that they take part of the risk. So you start looking how you can start distributing this risk vertically to a second floor and even to a third floor. So this reinsurance company as well, they distribute the risk in financial products like cat bonds or other types of financial instruments. That as well is not them completely taking the risk. So this is what we have to learn and we have to replicate in the development areas. If we really want to scale to the level that this insurance sector have been able to do it, no? Yeah, you want to say something, Christian?
Yeah, maybe just quickly on DF. I think it's a critical point that you raise, right? That we really also make use of some of the private sector instruments much more in how we deploy ODA, because and I think it again about the efficiency of guarantees, right? I mean in comparison to if using grants, because you have potentially you can use these funds over and over again, but also in some cases you can also even ask for guarantee fees, and hopefully you should, so that it is even financially sustainable as an instrument or as a company, for instance, like with Pitch, that we're doing this. And I think that really speaks to the efficiency, and I think also the OECD has concluded, right, that this is like 5 times more efficient than all the other instruments that we use to de-risk and to mobilize private finance. So I think we really should, it's also an invitation, right, for us all to rethink how to use ODA.
Exactly, and this is the point of this session, why we are not talking more about risk mitigation mechanisms. I have been a little bit critique about how we always tend to push attention too much in pushing money to climate finance to address, and the discussions at the COPs is, okay, who's going to bring the additional 1 trillion or 1.3 trillion, when we are not talking about the other aspects that are needed around, especially with, it's about risk mitigation mechanisms in place. And unfortunately, our financial ecosystem as well is not designed to bear this risk, at least in the development side. You know, when we talk about the multilaterals or climate finance, normally are AAA organizations that the level of risk as well is very low. Now, normally 95% of the World Bank, the lending is sovereign guaranteed. So risk is very low. It's not that they are taking risks that are needed now in order to mobilize the additional funding. So I think that's a fundamental question that as well I want to raise with the audience. How do we do in order to mobilize more risk mitigation mechanisms? No? And this is a question for you guys. How do you think we can mobilize more risk mitigation mechanisms and engage not only the development agencies, but as well private sector, philanthropists in this important topic?
Yeah, thanks. Maybe I'll start. Again, I think it's important to know who you're talking to, and I would only like to stress that we're quite good to talk to private investors, private fund managers, but we are not private sector, right? I mean, I might have a background from the private sector, and my whole team might have a background, but we represent an agency. And that might be scary for private investors and fund managers, but I think the importance there is to build the trust and build the understanding and the transparency of what do you, as a fund manager representing these investors that are going to come in, what do you need? And you're going to tell what you need, and we're going to tell you what we need, right? I heard something about guarantee fees. I love guarantee fees. I mean, guarantees should cost, right? I think it's a bit of a challenge when someone says, yes, we do want to invest in the least developed countries, but couldn't you as an agency come in and guarantee this, and it should be at zero cost? I get a bit concerned, and I'm more sort of turning it around and say, well, how much is it worth for the investors and for you to get this up and running? So I think it should cost. We could subsidize the cost so everyone feels comfortable with the risk reward and the benefit and achieving the targets of whatever sustainable targets you have put into play, right? So it starts with trust, and it also starts with time, that you have time to dedicate to find the solutions. I mean, what Mark is talking about here is just super interesting, right? And we at CEDA, we could take other risks than credit risks. So as long as someone comes and tells me or my team saying that we want to do this, we want to shift our money to over here, but there's one thing that is not unlocking it. The risk is not matching the return, or the risk and the return is not matching our mandate. Well, guess what? We and others do have the key to unlock that, right? We could come in again with our guarantees and saying that this is how we shift the risk return, and you would be able to do it. But it would likely take time, and it would likely cost a little bit. But what is also important, and I think that has been a learning curve for us as well, I think we're getting better at it, but that's how can we find solutions that is replicable, right? That someone can look at and say that, okay, we could take this and we can move it into this geography and we could do the same. Or we could take it from these sectors and we could do the same. That is highly crucial. And we as an agency are also getting better at, if we like to work with these partners, we can consider to do other things as well. But we're always going to have one more question, and that is, when are we out? When do you not need the Swedish agency to do this? When is the market ready to come in? When is the perceived risk coming down to the real risk, right? It's fine if you tell me, well, Peter, it's likely going to be 15 years. That's fine. But at some point, you need to tell me, when am I out, right? Because I love innovation, but I'm just going to finalize with this. I do want my work to be a bit more gray. I mean, it's snowy in Sweden now, but I want my work to be a bit more gray, easy, simple, straightforward. It's not at the moment, right? So the more we can harmonize, find the easy solutions that can be replicable, the better it is for me, because then I can spend time on the snow and not finding this digging, trying to find the innovation, right? So that is a bit of some thoughts, I guess.
Once an insurance company, a guy that works there told me that the business of insurance company was not to pay, was actually to build trust. And actually, this is the way that guarantee should be framed. It's not to pay, it's how do you use that instruments to build trust between the stakeholders that they should be doing business. And this is where the philanthropic guarantee of Mark makes a lot of sense. This is a copy from a US fund that is called MCE, that they created a philanthropic guarantee of $150 million back that has been operating for 12 years. And this guarantee is backed by 145 philanthropists. Each philanthropist have a ticket of $1 million. And that guarantee allows MCE to lend to countries and to institutions that they will not be able to lend if this guarantee will not exist. The interesting thing here is that each philanthropy, at the end they have been operating for these 12 years, and they have an average payment of $6,000 per year. This is the amount that they are paying from their commitment of $1 million. So you can imagine the leverage that that $6,000 have in terms of moving financing to other places. This is what actually we are trying to do with in the refugee camps. How do you put a pool of philanthropies backing these PPAs contracts for allowing the private sector to offer solar photovoltaic in humanitarian settings, where the risk again is the early closure of a humanitarian setting, right? Mark?
Yeah, very true. You know, as I mentioned earlier, you know, all the decarbonising activity that's undertaken at the moment is largely done on a grant-based process. And if we rely on grants, one, there isn't enough money to deliver the impact that we actually need. As much as I love all our humanitarian partners, we're not energy companies. You know, we don't know how to operate and maintain a solar photovoltaic system. And we shouldn't. We should be concentrating on our core mandate of protecting those that are vulnerable. And dare I say, dirty word in terms of UN procurement, you know, we race to the bottom in terms of cost. And the lowest cost solution, rarely the best solution for us, irrespective if it's for energy or not. So this is where we see leasing agreements and PPAs stepping in. And there is one example out there, and it hasn't been replicated in the 4 years it's been operational. And that's because there is no guarantee mechanism behind it. So the guarantee is an increased cost. That cost is approximately $1 million over a 10-year period. Now, money is being saved because the diesel is being flown in by helicopter. So we're saving money, that's great. But we can't afford to overpay electricity costs to cover this risk. So this is where I feel the guarantee is has a huge potential to unlock this. And I really see it as the sort of glue in building the relationship between the humanitarian partners and the energy service companies. It's really needed because otherwise we won't deliver at scale.
Correct. This is another learning from the insurance sector. They can guarantee everything. Everything that you can imagine can be covered by an insurance. Even the legs from Beyonds are guaranteed. It's not a joke in the UK market, in the insurance sector, and it can be guaranteed a car. Why can they can do that? Because they distribute risk. They put everything in the same basket, and they know that if some situation happens, it's not going to affect the other ones. So they distribute that. So we have to learn that about the insurance sector. The other thing that we have to learn is about the different layers. And they have a very beautiful example in Argentina. Some years ago, I was involved somehow in the Renovar initiative policy, where they were trying to do auctions, where they offering the government solar and wind PPAs to large project developers in a country that was declared defaulting. So they were offering, you know, I will pay you to the best price, solar photovoltaic, a contract in 15 years in US dollars. Who, in the good thinking, will be investing in Argentina for that? Well, the government, and they managed to build a 3-layer guarantee scheme. Basically, a cash guarantee that was guaranteeing partially that, a second layer that if that failed, the second layer will pay, and the third layer, that was the World Bank, actually guaranteeing the second layer. So everything at the end was to provide trust. It was not to pay, because the guarantee has never been triggered. It's about building trust. And well, here's about a question for the audience and as well for you. In your opinion, what risks are stopping private investments in climate solutions in developing countries? If you can help us to rank where do you see the risk? Scanning these questions, and as well I will give the time to the panelists to respond, but that will help us to understand where's the sense about a risk mitigation mechanism. So do you want to start responding, Peter?
Yeah, some interesting risks there, right? I think there's one thing that we do not really have the mandate to change, but I think what we usually discuss at length, that is in our markets, which is basically all the ODA countries, and is the lack of institutional and regulatory capacity, right? I think I just told you that I wanted to get out of my job. It would also be a quicker fix if we do look at number 3 here, regulatory, unclear rules, bureaucracy. I think what investors are telling me, and you could tell me if I'm wrong, I guess, is that if there were sound institutions that you could rely on, that you could rely on getting the security that you have on a loan in all of these markets, money would start to flow as well, right? There's no joke when some of these countries are doing things and they need to have the arbitration or the contracts under English law and the arbitration in London. That's not because everyone loves London, right? It's because it gives a stability to the arrangement. And again, it comes down to trust, right? So I think number 3 is important. I can only say that all of the other risks we are indirectly or directly looking at and take into account in our pricing. That is, again, being asked to be paid or subsidized partly. I do need to say that, yes, we also have quite few defaults or payouts in our guarantee portfolio. But what I'm telling my leadership and our government is that if we're being called upon, we're happy to pay, you know? That's also the trust, right? So, but it just shows that the real risk is not the perceived risk, right? I'm going to end with, it's not a climate thing, but it's in a context, in a Kenya context where we were providing a small guarantee, small but highly impactful for women Somalia refugees that have lived in the Nairobi context for 20 years, where the bankers were telling us that they needed 100% guarantee to provide lending to these small businesses. And we told them that, okay, you need some skin in the game. We cannot do 100%. The question came down to, have you been there? Have you met these women? They said no. So we asked them to go, and they went, and they came back and said, well, we can do 60%. That is just one story. I'm sure we have more, and you might have that, but the perceived risk to the real risk, we can talk about these risks, but that's something that we can only overcome if the asset owners and asset managers and whoever you represent truly wants to go there and spend time and understand. Sorry, I'm taking a lot of time, but I'm going to say one more thing. I had a lunch a few years ago, and that was with the head of African origination, right? It was in a Nordic context, and they were asking me a lot of questions. Okay, what do you do when you go to Ethiopia or Kenya? How do you visit the companies? What do you do? I was happily sharing, and I was asking, but what about you guys? How do you do it? She had that position for some time, and she said, I've never been. That is one of the problems as well, right? That's a risk, that we have never been there, right? How can we shift this if we have never been there? So, food for thought, I guess.
A lot of the risk are perceptions, are linked to emotional things. No? I joke with my team that people is buying Teslas not because they are saving the environment or because they are saving money. It's because they look handsome inside the car. So here as well, it's about how do you perceive things in a different way. Christian?
Just a quick comment. I mean, on one hand side, it's really interesting to see that you think that ESG risks are really not an impeding factor, right? I also think, yeah, the regulatory ones I mentioned before, this is really the long-term institution building, regulatory reforms, etc., that stays important, but is a bit beyond what we discussed today. And then on guarantees and misperceptions of risk, right? I mean, this gap between the perceived and the actual risk, I think it's just, we discussed this a lot last year, building bridges, this year as well. There was also building bridges bringing a lot of investors to Kenya. I mean, would have been great if there were more, but I think it's an initial attempt and we should do more, and applaud building bridges for doing that. And there just as well, I think guarantees are so powerful as a demonstration effect to narrow that gap between the perceived and the actual risk, because over time, if you see that these guarantees have not been used, actually, it shows that the risk is actually much smaller, the actual risk is much smaller than the perceived one. And so I think in that regard, it's also a very powerful signal to the market, much more than if you do direct investments on concessional terms.
Yeah. Mark, what is the risk that humanitarian setting closes soon?
Yeah, I think the biggest risk, as we talked about, really is the termination clause on the long-term contracts. But I think when we talk about humanitarian settings, there's also the political risk that's associated. You know, most hosting countries are talking about refugees and displaced in short-term language. You know, they will be going home next year. How do we develop a long-term business when the political language is saying something very different? So again, this is where a termination clause is very, the guarantee for a termination clause is very important, because most refugee settlements, as I've already mentioned, are 18 years, if not older. So there is a level of permanence. And therefore we need to find a solution that doesn't show permanence. So we're installing solutions that look temporary. So we have to go shipping container solutions where we can pour them out of a shipping container, the shipping container stays there and we can push it back in. But it's constructed and all its parts can last for 20, 25 years. So this is, I think, one of the big risks in managing that. I think there's also a market risk. You know, where we are located is generally remote locations. You know, there is a question of affordability. How can people pay for it? And the system sizes are small. So the actual risk reward profile is not interesting for many companies. So how do we get private sectors that are interested from a social perspective, interested, but we still have to guarantee that investment? Yeah, I think.
Yeah, I'm going to be picking some questions from the audience, so if you have a question or a comment, please push the button on your mic that you have in front of you, say your name and the question.
But then welcome comments from all the panel as well. Regarding guarantees, I think there's a big question on, you know, pricing and coverage and striking the right balance between, you know, being additional, but at the same time not crowding out potential private sector activity that could have already happened. So I wonder what factors you take into consideration to determine what the pricing should be and the coverage for these transactions that strikes that balance. And also speaking at a portfolio level, you said, you know, there's a tolerance for some default, but overall, what's the appetite, you know, the risk appetite at portfolio level and for, you know, potential default from transactions? Thank you.
Thank you. I try to be super short here. On the pricing, we basically do an expected loss on the guarantees, no matter if it's non-credit guarantee or if it's a credit guarantee. It's an expected loss, and we look at the geographies that structure is going to invest in, right? I'm happy to talk more about that. The level of risk sharing and why we're even in there is that in our mandate and in what we're allowed to do, we're only allowed to engage if the market is not there, really, right? We're not allowed to distort the market. We're not allowed to to say that, okay, this has already been done by the insurers, well, then we should not do it. I can only say that most of the times, and in our pipeline as well, it's a clear testament that it's been there for a while in the pipeline, so it cannot come to market without our support because no one else can do it. But I'm happy to talk more about that. On the number of defaults, I think our view, SIDA's guarantee offering is part of Sweden's whole guarantee model, right? And the view we take in the guarantee fee, we set it aside and use it in the government's budget, right? So it's just a number. Over time, that number should be 0, right? On a long horizon, our pricing should match the risk we take. Obviously, it's theoretical, right? And it's over like hundreds of years, they tell me, my colleagues that price it. But if the full thing would blow up, it would blow up, right? It's not likely to happen, but if it will, right?
Thank you, Peter. We have another question over there.
Thank you. Patricia Richter, International Labour Organization Social Finance Program. I like the slide with the perceived risks. You will probably only be able, through a guarantee instrument, to pick up a little part of those perceived risks. What other services do you integrate into a guarantee instrument to also support the guaranteed institutions to actually lower the perceived risk also on other risk categories? So that's the first question. The second one is, I find it really interesting that E and S risk perceived was the lowest one, which we are used to seeing that. But I think this is actually a crucial one to get institutions to expand their coverage and to create more clarity what E and S means. And I think just the two words that were added behind don't give justice to what is actually behind it. So maybe that's also for all the participants to put more thinking, what is this E risk and what is the social risk that could be out there, and how can we really address it? It might actually not need a guarantee, but something else.
Thank you. Anyone wants to?
I'm happy to go with the technical assistance question, because it's very specific from us, and those that work within the UN will probably not be surprised. You know, if we're not doing these things on a regular basis, we struggle to be innovative, we struggle to move the needle when something new is presented to us. So I think with the guarantee mechanism that we're talking about, there would definitely need to be some legal support to work with the legal teams within the partner organizations to shift away from pure procurement to leasing. I think there's also a procurement role here. You know, what are we actually, what is the process? How does that not look like a loan on our balance sheet? Because obviously in the UN we can't take loans. But also we need more energy specialists just to make sure we're actually, you know, getting or designing the right systems. Just for those that don't know, we can't actually invite a private sector entity in to design the system for us, because if we do that, they're excluded from the procurement process. So we actually have to present a baseline for bidders to come into, which can be the refined by the preferred bidder at a later date. So technical assistance is much needed as part of this process.
Thank you, Mark. Briefly.
Just super quick. Everything we do with our guarantee offering is in a systemic approach together with ODA and other work. It could be TA to the guarantee, but it can also complement with sort of regular grant work that we do, right? So we rarely do a guarantee in isolation and just say, this is opportunistic, let's just do it. It's in a broader scheme. So I fully agree on that. Thanks.
Thank you very much to the three of you. It has been a very interesting discussion. Please, if you want to talk with the guys here, to get more insights as well, Mark. I know Amy is somewhere over there if you want to address about the humanitarian. Yannick as well here. So thank you very much. A big applause, please.